Hi, my name is Joseph Gutierrez, owner of MyLifeInsuranceBroker.net, and this is Covered in Compounding. Today, we're going to be talking about the differences between traditional banking and infinite banking. Okay, so when we talk about traditional banking, most of us have this idea in mind that we take our earnings, our income, and we put into a bank account, a checking account. Why is this good? Well, because we don't necessarily carry around briefcases full of money to go to the grocery store, to go to the mall, to go buy a new car. We're able to store our money in a safe place, in a secure place, like a bank's checking account or savings account. In the past, what was nice about putting our money in a checking account is that we did have some kind of interest that was applied to our money as it sat in there. Okay, so this interest rate may be a small interest rate, but at least it combated inflation. The only problem is today we don't necessarily have that anymore. I don't know if you spend time looking at the interest rates for checking accounts for the major banking institutions, but they're essentially zero. Okay, so our money is essentially dead inside of that checking account, basically losing value day by day to inflation. Okay, so one of the ways people try to combat this is take their money out of their checking account and throw it into some kind of investment. Let's say some kind of high-powered tech stock. That may be great, but a lot of times individuals feel forced to do something with their money because, as Ray Dalio says, cash is trash, and they may force themselves into an investment they may not be ready for, catch it at the wrong time, and have opened themselves up to a loss of principal. Okay, so what's a better way to handle this? Well, we can utilize the infinite banking concept to combat the lack of interest that's being accrued on our money. So what is the infinite banking concept? Well, it's essentially a whole life policy that is geared to maximum cash value accumulation. Okay, so this well-constructed whole life policy allows our money to grow compound interest year over year through the use of dividends. Okay? These dividends grow uninterrupted, compound interest, and tax-free, as I always say in my videos. What's nice about this is that in a very similar fashion, it's similar to a HELOC or a line of credit. Okay? So whether we pull the money from the policy or not, our policy continues to grow. Okay, this is the uninterrupted portion that we're talking about. So let's look at a real estate example for those who are not as familiar with life insurance. If I have a primary residence and it grows year after year with the market, let's say 5%, it doesn't necessarily matter if I get a line of credit on that property and I go buy a car with it. My property still grows at 5% year after year, whether I take money out of it or not. Okay? In the same way, we can do this with our own life insurance policy. Okay? So next, we're going to be talking about conceptually how this can work for individuals in their late 20s to early 30s, for example, and how one is going to defeat the other in terms of overall growth and investment opportunities. Okay, so now we're going to be following the life story of two individuals in their mid-20s and following for about 10 years. Each individual is going to be using their own style of banking. One the traditional route, one the infinite banking route. Okay? As a ground rule, to lay the ground rules here, each individual is going to start off about $50,000 in their account, whether it's their checking account or on the other end inside their whole life policy's cash value account. Also, keep in mind that each individual is going to be saving about $800 a month. That $800 a month can be applied to putting into their account, paying off a policy loan or an auto loan or any kind of loan, or just any kind of payment for any kind of asset they're trying to acquire. So we're going to be following these individuals for their three major purchases, kind of seeing how each type of banking strategy works. So we're going to be looking at the purchase of a car, of their primary residence, and of a rental property. Okay, so we're going to space them out 5 years apart. The first year we're going to be looking at purchasing a car, 5 years later, the home, and then 5 years after that, a rental property in this case. So we'll have a little bit of fun with this, okay? So on the traditional banking side, we have our main character. We're going to call her Susie Saves a Lot. Why? Because Susie saves her money. She's not frivolous with her money, but she also is a little more conventional and basically does what her parents told her to do with her money. Save it and apply it wisely. Okay, so we can see in her first year here, she's going to be purchasing a $25,000 car. So she decided to finance this car and pay it off fairly early, within 5 years. Okay, so her down payment is about 10%. Okay, so $2,500, and she's going to be making $500 payments every month until it's paid off. So if she saves $800 a month, the other $300 is going to go into her checking account. $300 plus $500 equals to $800. So over the 5-year period, she's paying down the auto loan, and what's ever left over, in this case $300, is going into her checking account. 5 years later, it's time for her to buy a home. She's got a paid off car, all is good. She also, her bank account now shows about $65,500 some odd dollars. Great. So she's looking at a home, her first home to buy. She has a $400,000 home that she laid her eyes on that she really likes. Okay, in order to acquire this property at the interest rate that she likes, for her down payment plus closing costs, it cost her about $40,000. Well, she saved about $65,000 at the end of the prior year, so she's in a good spot to pick up this property. Not only that, she's saving the full $800 a month or $9,600 a year. So all is good. As time goes on, she is continuing to save her money of $9,600 a year until about 5 years later, an investment opportunity comes around of a 4-unit apartment for $300,000. This is interesting for Susie Saves a Lot. She's interested in getting into real estate as an investment vehicle. So she's looking at the property and decides she can get it for a $300,000 and needs about $70,000 of the down payment plus the closing costs. Okay. She's looking at her bank account and she sees about $73,000, $73,500 some odd dollars sitting there for this purchase. It's a little tight. Not only that, when she does go to get financing, the financing institution is going to tell her, hey, we not only need the down payment plus the closing costs, but we also need about 6 months rent reserve. If the rent's about $3,000 a month, $3,000 times 6, about $18,000. So if we do the quick math on this, we've got the $70,000 plus the $18,000. She needs to have a cash amount of $88,000. Unfortunately for Susie, not quite there yet. She's only at $73,573. Unfortunately, she's going to have to pass on this opportunity. Okay, next, let's look at Walter McWealthy, okay, and see how his strategy is going to attack these purchases. So, for Walter, he too is starting about $50,000 in his first year. He also saves the $800 a month, just like Susie. Major difference is that he has already funneled that $50,000 into a whole life policy, and it sits there in his cash value account. He's making monthly contributions of about $300 a month or $3,600 a year, and the remaining amount can be used for whatever he chooses. In this case, he's going to be using it to pay down the policy loans that he's taking for these purchases. So this is important. This is one of the important aspects about infinite banking. You are your own banker. You also want to be a good steward of your own money. And you don't want to cheat yourself. Okay, so every time you make a policy loan, you make a plan to pay yourself back. Okay, because we want to maximize our cash value at any given time. And if we have the ability to pay it back, we should be paying it back. So in this case, Walter's going to be setting up an auto payment for $500 a month, and he's going to be using his policy like a credit card, like a line of credit for his purchases. So year one, just like Susie, he sees that $25,000 car. Instead of only putting a down payment and getting someone else to finance it, he's going to finance it himself. Okay, so he's going to buy the $25,000 outright with the cash value inside his life insurance policy. Okay, and then as we can see here, he's making that $500 payment month after month. He too is going to pay off the outstanding loan principal around the 5th year. About 5 years later, he's looking at the same kind of house, a $400,000 house. He needs $40,000 for his down payment. Looking at the cash value, we see that the prior year, at the end of the prior year, he has $78,263 in his cash value account. Now wait a second here. That's considerably more than Susie's account at the same time. If we look back at Susie's account, she only had $65,573 in her account at that same time. So we're already ahead, and it's only been 5 years. Okay, so keep that in mind. So we purchased the home, we borrow against our policy for that $40,000 down payment, and we continue making our $500 payment every month back towards the policy. So about 5 years go by, and the rental opportunity comes along. Same circumstances. This is a 4-unit apartment. It has a price of $300,000, and he needs $70,000 for the down payment and closing costs. Okay. We also still need that 6 months reserve per the lending institution's requirements. We look at our cash value. We look at our outstanding loans on the cash value of the outstanding loan from that $40,000 down payment on the first house. We notice something interesting. Our cash value is $95,665. We still also have an outstanding loan principal of $16,846. So we haven't quite paid off the original loan, but that doesn't matter because now we not only have enough cash value for the down payment, we also have enough for the reserve amount. So we just borrow against our policy again. Okay, we're utilizing our policy like a line of credit. So we're going to borrow the $70,000, and now we have this new cash flowing asset. Over time, Walter McWealthy is going to be increasing rents, and the cash flow from that property can be used not only to pay down the policy loan faster, but it can also be used to acquire other assets. Okay, and so in this example, Walter McWealthy is going to take the cash flow, let's say it's about $500 a month of positive cash flow. He's going to take that money, put it into his independent brokerage account. Maybe he buys some stocks that he likes, maybe he buys dividend yielding stocks, maybe he buys a tech stock that he really fancies. Either way, he just acquired 2 assets from his whole life policy, the fundamental asset as I call it. He acquired the rental property, and now he's acquiring stocks. Okay, so now we can see how the infinite banking concept just blows the traditional banking concept out of the water. Okay, and this is one of the major draws for a lot of wealthy people to utilize the infinite banking concept for their business opportunities, investments, for overall just purchases. Thank you for watching our video on the comparison between traditional banking and infinite banking. If this is something that you'd like to explore for your own self, or if you just need a life insurance policy in general, feel free to reach out to us by clicking the scheduling link in our description below. Thank you for watching. Click like and subscribe to our channel for more content, and I hope to see you along our wealth building journey. Until next time.